Looking ahead toward future interest rate actions, many investors may be wondering, what is the upper limit of the Fed's potential to raise rates? How effective is Fed policy likely to be in the future? Deepika Sharma, a portfolio manager with Aster Investment Management, addresses these questions and other important issues affecting long-term interest rates.
Navigating the low-return environment has been one of the top concerns for investors all year. In fact, over 35% of the global treasury market is trading at negative nominal yields. Which begs the question, why are interest rates so low? The common answer that it's because the Fed or central banks are keeping rates low or because of the 2008 financial crisis are not entirely accurate. Low interest rates are not, in fact, a short-term phenomenon. Real 10-year yields in the US have been declining since the 80s, whereas nominal 10-year yields started out low in the 60s, peaked at 15% in 1981, and have been falling ever since as well. So even though the Fed hikes by another 25 basis points this December, we have to ask, what is the upper limit of the Fed's hiking potential based on this long-term trend? And as a result, how effective is Fed policy going to be in the future? This is an important question because low long-term rates mean that equities and other risky assets will remain overvalued, and fixed income investors will struggle to meet target returns. First of all, the Fed cannot create growth. It can only affect money supply and nominal rates and is unable to solve economic challenges or influence real rates. So tracking the state of the economy is what ultimately determines the long-term real return. At Aster, we track these trends in the economy using our proprietary Aster Economic Index and incorporate economic data into all our portfolios. Second, the long-term trend in real rates made previous Fed policy tools such as the Taylor Rule ineffective. The Taylor Rule assumes a constant neutral or equilibrium Fed funds rate, whereas both FOMC and markets agree that the neutral rate is much lower. In March 2015, Janet Yellen admitted to a non-constant neutral policy rate, and others including Stanley Fischer and Ben Bernanke have spoken about it at length. Third, we have also seen FOMC participants consistently shift down their long-term economic projections. The reason for the shifts are the same as the reasons why interest rates are low, and hence these are the variables that we are keeping a close eye on. Productivity, which has disappointed with only 0.5% average growth in the last 7 years when economists were forecasting over 2%. The relationship between payrolls and growth, even though payrolls showed a lot of improvement, but that didn't translate to faster growth, which can only mean that the US growth potential has lowered as well. Third is inflation. Wages have remained stagnant and inflation hasn't gone up despite the payrolls growth. The only likely explanation is that the relationship between wages and payroll growth has changed because inflation expectations are much lower. And lastly, structural factors such as high savings rate, shifting demographics, and low amount of capital spending and investment have also lowered the real interest rate. If these factors don't improve, it's questionable how effective Fed policy can be in the future, possibly during the next recession, since the Fed cannot change the real economy. In addition, after QE, Fed holds more than $4.2 trillion in assets, mainly treasury bonds and mortgage securities. This raises the question of whether the Fed will become an active seller moving forward and how that will further impact fixed income securities.
To find out more about how Aster can provide you with portfolio solutions, please visit our website at www.asterim.com.